right, welcome to the MSL Business School, MSL here, and we are still on our discussion on international financial reporting standards. This will be of help to anyone sitting a corporate reporting, financial reporting, or strategic business reporting paper, right? Okay, if you find this video helpful, leave a like, share with your friends or those in your network, and subscribe to our channel, right? So what is our requirement here? Straight away, it says explain and show how the events described above would be reported in the financial statement of MSL PLC for the year ended 30th September 2015, right? So what does the question give us? Key thing when it comes to questions on standards, especially for non-current asset standards, is to be mindful of the dates. The dates are so important, right? They tell you just too much information you cannot ignore, right? So take note of the date in the question. So we're told MSL PLC is an entity which is engaged in the construction industry and prepares financial statement to 30 September each year. That's our first date. This is their year end. They prepare financial statements to 30 September each year. So that is their year end. So your year end is when you do your reporting too, right? All your financial reporting will be done with reference to your year end. Yeah. So we need to make sure we always keep track, keep our eye on the year end. The financial statement for the year ended 30th September 2015 are shortly to be authorized for issue. Anytime I see authorized for issue, I begin to ask myself, will there be something under IAS 10 event after the reporting period? But let's see, right? So they are about to authorize financials for issue. So let's see what happens. The below information is relevant to the question. On 30th June 2015, something happened. Now, we said your year end is 30th September 2015 in this current year. So when will the year typically start? Are we good? You need to ask yourself, what is a 12-month period? When does the year start? If you look back 1 year, your year will start on what? The 1st of October 2014 to 30th September 2015. This is a full 12-month period. Are we good? So this is our full year. So on 30th June 2015, somewhere within this 12-month period, right? The directors of MSL PLC decided to dispose of 2 properties in different locations. Both properties were actively marketed by the directors from 1st July 2015, and sales are expected before the end of December 2015. Still sometime, remember the year end is what? 30th September of what? 2015. But they expect to sell sometime by December. Summary of the 2 properties are provided below. So we have property A and B as the question gave us. There are 2 different properties. So as at 30th September 2014, take note, we need to know our year ends, right? This question has a year end of 30th September 2015. So as at 30th September 2014, the carrying amount of the assets, property A, this 25 million. Everything is in thousands, so take note of that. 25 million for property A and 22 million for property B. 25 million for A and 22 for B. Now, the carrying amount is the amount at which the properties are stated in the financial statement as at year end. So as at year end 2014, September, the assets were carried at these amounts in the books. Now, depreciable amount is basically the amounts that you subject to depreciation. So typically, if you are doing the straight line method of depreciation, you are looking at the cost minus any residual value or scrap value, right? It is the amount that you systematically allocate over the useful life of the asset as defined by the relevant standard, IAS 16 for property, plant, and equipment, and for your intangible assets, IAS 38, right? So we are looking at an amount of 15 million for property A and 16 million for property B. This is your depreciable amount, the amount subject to depreciation, not the same as your carrying amount. Okay. Then we are told that as at 30th September 2014, once again, the dates are important, right? Our current year end we are making reference to is 30th September 2015. So as at last year end, property A had a remaining useful life of 30 years. Property B had a remaining useful life of 40 years. We'll need this for depreciation. Then we are given the same properties, right? Property A and B, the estimated fair value less cost to sell as at 30th June 2015. You can see the dates are important. We have information at September 14, September 14 again, September 14 again, but this time June 15, June 2015. So estimated fair value less cost to sell at June 30th, 2015 is 28 million for property A and 18 million for property B, right? So why do we need to have information at 30th June? Do not forget we are told that on 30th June 2015, the directors decided to dispose of the two properties. So they've given us information. This is the date of decision, your decision date for what? Disposal. The information we have at 30th June 2015 is the date the directors decided to dispose of the properties. All right. Property A was available for sale without modification from 1st July 2015. If they made the decision on 30th June 2015, then 1st July 2015 is the next day after they made the decision. So property A was available for sale immediately without any modifications from the next day the decision was made, right? On 30th September 2015, which is what? Our year end, I said a trick with non-current asset questions, standards of this nature, you will always have to track the date. If you mess up the date, you are in big trouble, right? But they're not difficult. Just keep a tab on each particular date, right? So 30th September 2015, this is our year end. So on 30th September 2015, year end, directors of MSL PLC were reasonably confident that a sale could be secured for 28 million. Do not forget 28 million is a figure we saw here, which is the fair value less cost to sell, right? However, after the year end, property prices in the area in which the property is located, property A, started to decline. This was due to an unexpected adverse local economic event in October 2015. Now, October 2015, how long is it after September? It's the next month. So some adverse event occurred after the next month. And here your mind should be buzzing around events after the reporting period, like I mentioned, right? If you missed it the first time they mentioned authorized for issue, I'll touch on these principles shortly, right? But this should give you a clue that, okay, could there be something here I should talk about? All right. Following this event, what happened? The directors of MSL PLC estimated that property A would now be sold for 22 million less selling cost, and they were very confident that this lower price can be achieved. So after the event that led to the lower prices, they were quite confident that they could sell at a lower price of 22 million. This is what we were more confident about, not the 28, right? The question is, when did you get information for this 22? You got it after year end. It's after year end. So this is after what? A reporting period or after year end. You could tell that, all right, I could do 22 million instead of the initial 28 million I thought I could what realize the property for. Okay. How about property B? Property B needed some repair work carried out on it before a sale could be completed, right? This repair work was carried out in the 2-week period beginning 10th October 2015. When is October 15? Remember, our year end is 30th September 2015. So technically, they started 10 days after year end. That is when they started the repair work, right? The 2-week period beginning 10th October 2015. The cost of the repair works will be reflected in the estimated fair value less cost to sell of 18 million. Where do you find 18 million? It is right here, as you can see, right? We have 18 million there. Okay, this estimate remains valid. So the question is, how do we account for this? Now, for you to be able to do this, we need some basic standards. Let me run us through that quickly so we can what? Attack this question. First important standard is called IFRS 5. This covers non-current assets held for sale and discontinued operation, right? Non-current assets held for sale and discontinued operations. So for this particular standard, what do we need to know? So when we say a non-current asset or a disposal group is deemed as held for sale, right? Held for sale. What this basically implies is that the carrying amount of the asset carrying amount will be recovered principally through a sale transaction, rather than through what? Continuous use or continuing use, right? Rather than through continuing use. So a non-current asset or a disposal group of assets, right, are deemed to be held for sale if and only if you have plans of recovering the carrying amount principally through a sale transaction rather than through continuing use. But there are some conditions for the held for sale classification. So the first condition, you have to meet these conditions before you can classify the asset as held for sale. It's a very high standard to be met, right? Before you can say you are classifying as held for sale. So the first thing is that the assets should be available for immediate sale in its present condition. Available for immediate sale in its present condition. Available for immediate sale in its present condition. The second criteria is that the sale should be highly probable. Sale highly probable. The third one, management should be committed. So you need a commitment of management, right? So management should be committed, right, to selling it or to seeing it through to the very end. So committed to a plan to sell, right? A plan to sell. We need commitment. So in questions, when you see them say there was a board meeting and they got board approval, it's a sign that they got management approval or management commitment to sell, right? Then you need an active program to locate the buyer. You should have started an active program to locate the buyer. You should have started looking for the buyer actively. Then we should also have what? Active marketing. Active marketing at a reasonable price. Reasonable price here is with reference to the current fair value. So there should be some form of active marketing for the product, not just an active program to locate the buyer, but you should also be undertaking some active marketing, looking for agents, people to help you sell at a price that is reasonable enough compared to what? Its current fair value. Then we should also expect sale. So sale expected to be completed. In less than 1 year. So you expect to complete the sale in a period of less than 1 year from the date of classification, right? So from held for sale classification date. So when you decide you are doing held for sale, within a year, you should have sold, right? Then the plan it should be unlikely that the plan, will change significantly or will be withdrawn or be withdrawn. It should be unlikely that the plan will change significantly or will be withdrawn. So you can see it's a very high standard you need to meet if you want to be able to hold your assets as held for sale. So let's come to this question again and let's try and find out. Let's answer the question. Have they met the classification? Now they said they want to dispose of two properties, A and B, right? Look at property A. It was available for sale without modification from 1st July. I said 1st July is the next date after they made the decision. It's available for sale without any modification. And they were confident that they will be able to secure a sale, just that the prices fell after year end. But at least we have proof. And then we have the management commitment because they decided to dispose of. It was done by the directors themselves. And what year? They said, let me clean this. We are told that both properties were actively marketed by the directors from 1st July, and sales are expected before the end of December 15. If they decided it to be held for sale from September and June 2015, and by December 15, they've done active marketing, they expect the sale to occur, property A is ready to be sold, they have given you all the indications that it can be sold in its present condition. Yes, the sale is highly probable. Management is committed to the plan to sell. There's an active program to locate the buyer because they are doing marketing. They are clearly doing marketing as well. They expect to sell within the current financial year, so less than 1 year. And then from the look of things, there's no likelihood that the plan will change or be significantly withdrawn. So you can say for property A, it kind of meets all of these different criteria. But can we say same for property B? That is the question here. Look at property B. We'll answer the question shortly. Do not worry. We need to analyze first. Property B needed repair work carried out before a sale could be completed. So property B is not available for immediate sale because you had to repair it first before you could sell it. That is not a sign of a property that is available for immediate sale, clearly. Right? They had to repair it before they could sell. That alone disqualifies property B from being classified as held for sale. Are we good? So let's use this criteria to do the analysis, and then I'll talk more about IFRS 5 and what you need to do, right? So let's start with our analysis. We can mention here that in this particular case, what is happening? We talk about the fact that this is under IFRS 5, right? So our applicable standard is IFRS 5, which covers non-current assets held for sale and discontinued operations. Right. Okay. So let's start with property A. Property A. What are the points we have been given? We need to mention what the standard says, right? So we'll say property A is what? Available. First point. Available for immediate sale in its present condition. In its present condition. What else are we told? This same property is what? Being actively marketed. Being actively marketed at a reasonable price. At a reasonable price, right? So these are things we've been told. At least we can see they also expect to what? Sell within 1 year, right? So you can mention all those other points. Expected to be sold within 1 year from classification date. right? Date as held for sale. So if that is the case, what is the treatment? The treatment of property A is that once you classify a property as held for sale, once it meets the criteria for held for sale classification, please take note, you do not depreciate anymore. Write it down. No depreciation from the date of classification as held for sale. But you do your normal treatment. So you will depreciate the asset normally up to the point of what? Classification as held for sale. Let's come back here. Let me show you something. I mentioned something about the importance of what dates in accounting. So this question, we have October 2014 to September 15 as the financial year, right? Okay. When was the held for sale classification done? 30th June 2015. So technically from 1st July, right? How many months from July to September? July, August, and then what? September. So we have 3 months. 3 months in the financial year when the asset would have been classified as what? Held for sale. Would have met the requirement. So for a 3 month period, you should not depreciate. I'll repeat this. Our financial year starts from 1st October 14 to September 15, right? In this question, the held for sale classification was done on 30th June, 2015. So it means July, the whole of July, the whole of August, and the whole of September, 3 months. You would have met the held for sale classification and you should stop depreciation in line with what? IFRS 5. So we'll depreciate for 9 months because for 3 months there is no what? Depreciation. What are the figures? If you look at the question, we can mention this. Depreciation ceases after held for sale classification. Are we good? So in this case, for property A, remember we are going to use the depreciable amount, not the carrying amount. So our depreciation will basically be, the question gives us the figures here, in case you missed it. We have the numbers here. Depreciable amount for property A is 15 million. Are we good? They said useful life is what? 30 years, right? So let's do this. So our depreciation will be 15 million divided by 30 years, but times what? 9/12. Why 9/12? Because for a 3 month period, the last 3 months of the current financial year, we were in the held for sale classification era, right? So let me pull out my calculator and punch this out. So yes, this gives me 15 million divided by 30 years times 9/12. This gives me 375,000, right? So this is Ghana City, 375,000. This is my depreciation charge. My depreciation charge for the year. This is up to what? Up to held for sale classification date for the current year. Right. Okay. What other treatment do you do once you are able to classify as held for sale? Because you expect the sale to complete within a 1 year period, the standard recommends that you reclassify the asset from your non-current assets to your current assets, or in a separate section of the asset side of the financial position statement. Just find a way to let us know that this is your held for sale or asset, non-current asset held for sale, right? So we have to do a reclassification, right? So the next point is at what value? So IFRS 5 requires the following, right? We can talk about what? Our reclassification from our non-current assets to our current asset section of the financial position statement, or a separate section of the asset side of the financial position statement, anyhow, right? Then it requires also a measurement Once you classify as held for sale, you measure the asset at the lower of two things. The lower of what? The carrying amount of the asset. Lower of the carrying amount and the fair value less cost to sell. Please take note of this. Once you classify as held for sale, the asset is measured at the lower of the carrying amount of the asset at the date of classification as what? Held for sale, and its fair value less cost to sell. So let's work for these individually. What is the carrying amount in the question? This would basically be the carrying amount at the end of last year minus the year-to-date depreciation up to the point of classification as held for sale. What is that? We are given the carrying amount at the end of the previous year. Here, right here, if you can see, we are told the carrying amount. Let me clean so everything is clearer to you. We are told the carrying amount at the end of September 2014 was what? 25 million, right? This is our carrying amount at the end of last year. So that figure minus our current depreciation up to the point of what? Held for sale classification should be the carrying amount at classification date as what? Held for sale. So it's going to be 25 million, right? Let's do it this way. So 25 million minus our depreciation we got here, right here, of 375, right? So this minus 375 will be our carrying amount at the classification date. So this 25 million minus this gives me a figure of 24,625. So this is the carrying amount. Remember, the standard says it should be measured at the lower of the carrying amount and the fair value less cost to sell. So we have our carrying amount. What would be our fair value less cost to sell? The question gives us that figure comfortably here. We are told that the estimated fair value less cost to sell, right? This is it. Estimated fair value less cost to sell at 30th June 2015, which is the classification date as held for sale, right? Is 28 million. That is what matters. 28 million. So we are told that figure is going to be 28 million. So we bring this here. This fair value less cost to sell is 28 million. Clearly, you can see that 24,625 is lower than 28 million. So we'll say this is the lower. This is the lower of the two. So we'll measure the asset at the lower of the two. So it means on the statement of financial position, the asset will be presented at 24,625. 24,625. So we'll mention that property A will be presented in the statement of financial position at what? Ghana cedi 24,625, which is the lower of the carrying amount and the fair value less cost to sell. Do not forget that at this point, we need to ensure that this is appropriately presented within the current asset section of the statement of financial position or as a one-line item, right? Just make sure your shareholders and the users of the financial statements are able to tell that this particular asset is currently classified as held for sale. So there should be a heading or a line, non-current assets held for sale or assets held for sale, something to distinguish that from your PPE or your property, plant, and equipment and other assets you have. There's one other issue we have to address if you want to score the full point in a question of this nature. We are told that although the 28 million is the price they are reasonably confident of securing, after year end, property prices started to decline. When that happened, there was it led to some other cascading event. This was mainly because it was an unexpected adverse local event, economic event. It occurred in October 2015. So this adverse event happened after year end, right? And when this happened after year end, they felt they could no longer get 28 million. They felt that 22 million, right, was more realistic. But the point we are making here is that there's a standard called IAS 10. So let me touch on that briefly. Hopefully, you've heard about this standard before. If you haven't, no problem, right? So we talk about briefly IAS 10, which talks about the event after the reporting period. There are two main types of events after reporting period. We have what we call adjusting events, and then we have non-adjusting events, right? At a very high level, adjusting events provide further evidence of conditions existing at year end, and they are adjusted in the financial statement. Non-adjusting events do not provide further evidence of conditions existing at year end, and they are not adjusted, but they are disclosed, especially when they are material. So only a disclosure in the note would be warranted. In this particular case, see it like this. There was an unexpected adverse local economic event in the period after year end. That led to you beginning to feel that your prices are no longer something you can realize. This does not affect something that existed at year end. It's an economic event that occurred after year end. You had no control over that, right? So we mentioned that the decline in property prices this is an economic event that occurred after year end. After year end, right? This is a non-adjusting event. It does not provide further evidence of a condition that existed at year end. That economic event could have been positive. Here it is adverse, right? It's not something you factor in the financials. So we'll mention that this requires disclosure. This event is disclosed, the price decline is disclosed in the notes to the financial statement. It is disclosed in the notes. Please remember, this decline in value will not be recognized, right? Decline in value is not what recognized. So would not be recognized. Very important to touch on this. Many candidates will just end here until the lower of carrying amount and fair value less cost to sell is 24,625. But mention the fact that the decline in prices came after year end. So if anything, it should be an event after reporting period that is non-adjusting. You need to touch on that if you want to score the full marks, right? So that should do it for property A. How about property B? For property B, clearly we said that it doesn't meet the held for sale criteria. Why? We're told that property B would need what? Let me zoom in for you. It would need repair work carried out on it before a sale could be completed. The standard says before you can go ahead to classify as held for sale, the asset should be available for sale immediately in its present condition. Nothing like, oh, you know what? Hold on, let me go and repair the asset. No. When you find a buyer, he should be able to take the asset home that same day or to their premises that same day. Because this property needs remedial work or repair work, it will not qualify as what? Non-current asset held for sale. We'll keep it as what? A normal non-current asset, right? So talk about this here. So let's now discuss property B. what happens to property B? For property B, we need to mention here that this does not qualify as a non-current asset held for sale. In an exam, try and write the full thing. I can do the short form here, right? Does not qualify as a non-current asset held for sale. Why? Key point is that what? Property B, the reason is property B needs repair work. We can say a property B cannot be sold until necessary repair works are carried out. Necessary repair works are carried out. So we cannot classify as held for sale. Because of that, property B, you depreciate as usual. There's nothing like depreciate up to a certain point, reclassify. No, it stays what? A non-current asset, which is not held for sale, but rather held for what? Use in the production and supply of goods and services or for administrative purposes. Are we good? So property B here, in this particular case, right, we are going to depreciate it normally for the whole period, right? So no reclassification. Property B remains or it stays as what? Non-current asset. So it stays or remains as a non-current asset, not held for sale. It doesn't move to what? Your current asset. So what would be your depreciation charge? For the full year, it gets a full year depreciation. So let's go and pick the figures here. We are told that the carrying amount at the last year end was 22 million. And then depreciable amount at the end of the previous year, 16 million. Remember, we said depreciable amount is what you use to what? Charge depreciation. So this, what is the useful life? Property B has 40 years. Property A, remember, was 30 years. B has a useful life of 40 years. So we depreciate over 40 years. It gets a full year depreciation. So our depreciable amount, so our depreciation will be our depreciable amount of what? 16 million divided by 40 years. We don't do any apportionment, right? It gets a full year charge. So 16 million on my calculator divided by 40 gives me 400,000. So this will be my depreciation charge for the year. We get a full 400,000. Now there's one advanced point you can mention, right? If this is the depreciation charge, let's find the carrying amount quickly, right? Carrying amount at what year end? Are we good? Okay. What was the carrying amount at the end of the previous year? We're told this was what? 22 million, right? 22 million. If that was 22 million, let's find the current year end. So current year end balance will be the 22 million from last year minus our depreciation charge of what? 400,000, right? And that looks like it's going to give me 21.6 million. 21.6 million. So these are carrying amounts at the year end. But hold on a second. You could end the question here, but there's one advanced point you could also mention. Let's look at something carefully. If the carrying amount of an asset is 21.6 million, its fair value less cost to sell is given as what? 18 million, as you can see here. And you are told again in the question that the cost of the repair work will be reflected in the estimated fair value less cost to sell of what? 18 million. Now, in this question, we don't have what we call the value in use. Remember, if you've watched our previous video on impairment of assets under IAS 36, you'd notice that there is something called the impairment test. for individual assets, right? You'd have to compare two main things. If the carrying amount of an asset is greater than the recoverable amount, the asset is deemed to be impaired, right? So in this particular case, we have a carrying amount of what? 21.6 million. If our carrying amount is 21.6, what is going to be our recoverable amount? It's basically the higher of the asset, what? Fair value less cost to sell, and the value in use. So we can say that the carrying amount of 21.6 million is greater than the fair value less costs to sell of what? 18 million. We do not have a value in use here to compare it to. But we can say this is what? Evidence of impairment, especially that the property is to be sold. So you expect the fair value less cost to sell to be a more reliable estimate of the recoverable amount than the value in use, because value in use, as the name implies, is the discounted present value from continuing use of the asset and eventual sale, if any, right? So we can say this fair value less cost to sell, despite the fact you don't have any value in use, this may be the most reliable indicator, right? Probably the most reliable indicator of what? The recoverable amount. Recoverable amount. So property B appears to be impaired, right? So although we cannot classify as held for sale, right? The intention is to be sold eventually after repair works. So the fair value less cost to sell is actually the more reliable estimate of what? The recoverable amount. We don't have the value in use, but we can say this is prima facie evidence that the asset is what? Impaired. Why? The carrying amount of 21.6 million is greater than the fair value less cost to sell of 18 million. The difference between 21.6 and your 18 million will be your impairment charge. You write down the assets to the fair value less cost to sell, and that will be it, right? So remember, in your questions for financial reporting, corporate reporting, right, you would need to find the relationship between a number of standards. Here we've applied IFRS 5 on non-current assets held for sale and discontinued operations. We have seen some bits and pieces of IAS 10, event after the reporting period. We have also seen some pieces of what? IAS 36 on impairment here. And then obviously IAS 16 on property, plant, and equipment, right? So these are some things you need to think about, right? These are some things you need to think about, right? So on that note, that will be the end for this question. As usual, if you like this video, give us a like, subscribe to our channel, and share this video with those in your network. Until our next video, it's bye for now.